So welcome to those that have joined us for our webinar today. I can see there's a few more people just starting to log on now. Maybe one more minute until we get the rest of the people joining us, and then we'll certainly kick off. It's a beautiful weather here in Sydney. If you're in Sydney, hope you're enjoying this lovely autumn weather that we're experiencing and had a great Anzac Day. We're really excited about today's session. So for those of you starting to click on, make sure that you can use the dialogue box and that there's no gremlins, that you can hear us. That'd be fantastic. So let me welcome all of you to the second in DPN series of live webinars for 2018, How to Invest Safely in Today's Market. Really super exciting topic. My name is David Bruce. I'm really excited to have our Managing Director here, Sam Khalil. He's going to share his 20 years experience and expertise in property investment. And we'll be going through a 30-minute session covering a broad range of great topics today. We will be taking questions through the session, and we're looking forward to hearing from you and answering those questions towards the back end of the 30 minutes. And we'll also be sending you a recording of this session, so you might be able to refer to later or even share it with your family and friends. So without further ado, I will introduce Sam Khalil. Sam, hello and welcome. If you'd like to introduce our topic today.
Thanks, David. Look, it's a fabulous day and it's been such a warm autumn. And look, our topic today is investing safely in today's property market. And look, this is probably one of the most discussed topics throughout, the year. A lot of Australians have homes or interested in getting into property in some way, shape or form. And it's always a question, where's the market at? What's the market doing? I love talking about property. I love talking about the market, what's happening, the research and that. So it's one of the things that I like talking about. So I'm really happy to share some insights today. So we'll start unpacking that, and not only about investing safely, but really investing wisely. So let's start that presentation. There's some slides there, and we'll start working our way through that. So just to recap, we're going to look at today's market, where we're at right now, the outlook for 2018 and beyond. What are some of the general trends and influences that we're seeing around, both locally and globally? The value of research, and then also what's DPN's approach or unique approach in that regard. So one thing that's really important to establish right now, David, is that when people say, what's the property market doing? It's such a broad generalization, because the reality is no one buys all of the property in Australia. So when people talk about the property market in general, that's really the average of all the houses in Australia. And you're not going to buy all the houses in Australia. So what we need to do is start to get a bit more specific than being general. And the fact is there's a multiplicity of property markets, as there are suburbs. So there are over 8,800 suburbs. You'll have a number of suburbs that are in decline. Some may be rising in a sense, some may be neutral. And when people say the property market's in decline, that might mean the overall average is going down, but that doesn't mean there aren't any opportunities and areas to look at. So what we need to be sure of is when we're looking at buying property, we need to have a horizon that's more, at least 3 years plus, an investment horizon. My background is financial planning, and usually when you look at investing in shares, you should have at least a 5-year horizon, understanding that there's volatility more in shares. But same thing with property. There can be corrections, change in market and that. So we don't look at investing property generally as an investor for a year. You're looking for at least a minimum of 3 years as your horizon, because we know the cost of getting in and out of property is quite expensive. For you to speculate for a year isn't a wise way to invest. Now, if you're developing or you're trying to do something speculative, you might look at shorter timeframes, but we need to look at a longer time frame. Also, we've seen Sydney and Melbourne, our two strongest property markets over the last 5 years have been amazing. You just had to throw a dart in any suburb almost, and the market momentum just took you and you made money. It didn't really require any skill or any research. It was just, you had to be there. And the problem is, you might be thinking, oh, well, I can just do that again and just randomly just pick any property and that will repeat itself. But unfortunately, that's not the case. So what that requires is the ability to start investing with being a bit more thorough, be a bit more forensic in your research to make sure. Then you might also say the market's overheating and cooling, because where our biggest population centres are in Sydney and Melbourne, we find that people define that market as those two cities. So they think there really isn't much to invest out of that, which isn't correct. So before we actually talk about specific areas, why don't we just look at some of the stats and the results that we've had over the last 12 months. So interestingly, our biggest city, Sydney, has now begun to cool, and just on average the city has a minus 2.1% return. However, we look at Hobart, which is one of the smallest capital cities, has actually shown a difference and had capital growth of 13% year on year. Then now let's look at the rental yield performance. Again, Melbourne, one of our largest and strongest growing cities, and one that keeps winning one of the best cities in the world to live in, David. They've certainly worked out some stuff down in Melbourne. I think that's because, you know, Sydney's certainly got wonderful natural attributes with the harbour and that. It had been a bit lazy, and Melbourne had worked very hard to make sure its cultural elements have done so well, and that's why it's one of the most livable cities in the world. But look at that rental yield, it's quite low. So again, massive capital growth over the last number of years, but rents have not kept up with that. So that's where we've seen that yield compression. Whereas you look at Darwin, you would think, wow, look at that. It is actually double the average rental yield. Now, if we then look at some of the average change in values, what we're seeing here is where the growth has been for the last year. Again, some of these next regions that are sitting outside of the capital cities, and we're seeing some of the bigger regions or second cities within states beginning to grow. Geelong at 10%, in New South Wales, Shoalhaven, Southern Highlands, 9.5%, ACT and Newcastle region about 8.3%, all the way down the Sunshine Coast about 5.3%. If we look at those going backwards, what we're finding is some of those really regional areas and mining towns and what have you are having some significant corrections. So they're the ones to certainly avoid. And actually, just before I'll go back a slide here. So looking at those four slides, the stats might show something interesting. We're seeing, you know, some of the smaller capital cities have either stronger yields or stronger capital growth. We're seeing some of the regional cities grow quite well, and we're obviously seeing some of the, you know, regional or mining or resource suburbs or regions correct. So it'd be quite easy from that to sort of say, okay, well, we shouldn't be looking at Sydney, we maybe should be looking at Darwin and Hobart. This is where it's really important that you need to contextualize the research or the data and the statistics, wrap it around a strategy, and make sure there's sustainability for growth. Because again, as I mentioned, we're not investing for 1 year. And if you look at Hobart and you think, well, look, this is tremendous, I need to be just looking at Hobart now as an investment, you need to be careful because, and avoid what I call spiked returns, you know, where you have just a strong growth for 1 year or a catch-up amount. The question is it sustainable? Is there consistent and compounding growth year after year? And that's really important. And also, what we need to do is make sure that we're also looking at what is the ability for growth around work and employment, because that's what's going to drive up the value of properties as well. I remember a little while ago, probably a couple of years ago, just before the mining correction or the resource correction happened, a gentleman came to us and he bought 2 properties in a resource town called Moranbah in Queensland. And he bought the first one just when the market was starting to rise. He worked in the area for about $450,000. It was now apparently worth about $900,000. He was generating $3,000 a week in rent. And I remember a lot of the property magazines were talking about these massive positive cash flow properties in these resource towns. And you know, $3,000 a week rent was just amazing. And you'd think, this is brilliant. I'll just get me a dozen of these properties. And he asked me what I should do. I said, sell them as quickly as you can. And what I found was that, I looked a bit back, did a bit of research in that region, is that there were a number of farmers who decided to sell their land because they could make far more subdividing that land than farming. And BHP, who were paying $3,000 a week, I just said to them, look, that's extortion. No one is going to keep paying that. That is purely someone who is desperate to pay. It is artificial and is not sustainable. And he didn't listen to me, and I said, look, you should sell both your properties, take the money, it's almost like a speculative stock, get out of there. He didn't. Within 6 months, 400 blocks of land came on the market, new houses were built, that flooded the market. You know, it was almost 10% of the market for a population of only about 4,500 people, which you can't do that in Sydney or Melbourne or even, you know, Brisbane. You can't just bring 10% of stock to those markets, but you can do something like that in a regional town. So it swung the other way. His property became vacant, BHP broke the lease, good luck to suing them. You know, his rent dropped from $3,000 a week to $450 a week. The market value dropped by $450,000. So yes, it looked tremendous for that time frame, but as I said, that would be speculative. And if you don't have that sustainable growth and those jobs coming in, you're going to have problems. So what I would look at is, you know, when we look at suburbs or regions to invest in, yeah, we want to look at the general trends and what's happening in those areas, but we need to look, widen the lens a bit and begin to look at you know, what type of products we buy in those areas, as in what type of housing we buy, that can give us the rental yields, because we could still look at, for example, Melbourne shows a really poor rental yield of 2.9% on average, but it doesn't mean all of Melbourne is only achieving that rental yield. Also, we might look at Sydney, which is corrected. Does that mean there are suburbs in Sydney that can still be growing, and that we can get the right sort of product there that gives the right rental return? Yes, absolutely. So we can see these general trends of regions, but what we want to look at is what are some of the regions at the right time and the right both price point and rental yield, and drill down to a suburb level, and we could do quite well. I would sort of say that the regions that you'd have on your radar right now that might be out of, again, generally speaking, outside of Sydney and Melbourne, what you notice there is Geelong. Geelong, if I flip back side, is at 10%. Geelong is really Melbourne's second city, and that's something to have on your radar. Newcastle and Sunshine Coast. So let's move ahead. And just before we do that, one interesting topic from I guess a product point of view, or a typology of investment in property is land or apartments. What we've seen is that apartments are certainly beginning to correct in the major capital cities. And why is that? It's just the first law of economics, which is supply and demand. And some lenders are even avoiding lending in certain suburbs and regions because of their exposure there. So the risk level is quite high. We're seeing some valuations coming in quite low for some people who've bought off the plan. We've seen lenders totally stop lending to foreigners and that. So there's been some fallovers and resales. So that's creating that oversupply around the apartment market. And we're seeing a cooling in the apartment market. So the sentiment around that's a bit of concern. Some developers are having a discount because lenders are requiring significant debt coverage for any new developments. So what we're seeing is that happening. And you know, the ability to build up is far easier than to build out. And the forecast for new land being brought to market is still quite restricted. You know, in Melbourne, one of the problems is even getting a registered land down there. You're waiting up to 14 to 18 months for that land to come to market. Same thing with some areas in southwestern Sydney. There's not many vacant blocks of land you can just go buy and settle on and just start building. They are being sold so far ahead that infrastructure still has to get in, because in these greenfield sites, you've got to put in new roads, you've got to put new plumbing, or new sewage and water treatment and what have you, electricity. That just takes a long time. So subsequently, what we're seeing is an increase in the land prices, and that's just across the board across Australia. When we say vacant land, I'm not talking about in the middle of Australia as in the Nullarbor Desert where no one wants to live. I'm just talking about, again, major cities where land supply is still constricted, and there is nothing on the immediate horizon that would say that would be a flood of land coming. So again, that's something just to take note, that on average, land is still appreciating, or the land values, whilst markets are dropping. So sustainable growth is driven by population versus any performance. So population is a real important metric. Look at this graph. I really love this graph here. This is so interesting to see what's actually happening here. If you look at over the next, say, 18 years, 2036, the next 18 years, what we're going to see is some significant population growth. And these are the regions I would be looking at if I'm going to buy a property. I would be looking at these regions in particular because, as opposed to having a spike or a nice yield maybe up in Darwin or maybe Tasmania, the question, or Hobart, the question is, what's going to have that sustained population growth? And then what I want to look at is what's that growth as a percentage of the population. Let me give you an example just to correlate here. If you look at Wollongong, which is really almost getting consumed as part of Sydney and Campbelltown region, that's going to go by 300,000 people alone. However, that is actually greater than Adelaide, which is a major capital city. So as a percentage, Wollongong is going to grow far more significantly than Adelaide. If you now also look at Geelong, its population today is probably about a couple of 100,000 people. As a percentage, over the next 18 years, it's going to have some dramatic growth. And that is Melbourne's second city. There's Avalon Airport is on the way up there, you know, and there's a connection there, as in a highway straight back to Melbourne. You can see Melbourne is potentially going to outgrow Sydney at 1.8 million people. But if you look at Sydney and then including Wollongong, you know, and maybe the Macarthur region and what have you, it'll probably keep on pace with Melbourne. Newcastle, very, very significant again. This is Sydney's New South Wales' second city. Considerable population growth. Now look at those three regions that make up what we call Southeast Queensland, the Sunshine Coast. Brisbane and the Gold Coast. Combined again, 2 million people. As a percentage of those existing populations, that's significant. And probably one that might surprise a number of people is Perth. What do you think, Dave?
Yeah, that was the key thing that I thought was interesting, Sam. I mean, obviously we've been through the period of Perth being the mining town and having that growth, and then, like you say, that correction. But those population, I mean, what do you think is going to fuel that?
Yeah, so it's interesting. So I'd probably look at Newcastle and Wollongong as examples. And there's a saying that BHP was the best thing that happened to Wollongong and Newcastle, as in coming, BHP coming, but also BHP leaving. And I remember when it happened years ago, when BHP announced it was shutting down, factories and what have you in those areas, those regions took a real hit. But it was actually the best thing for them because they had to reinvent themselves. They had to develop and broaden their economies. They were beautiful coastal towns, and they're great from a lifestyle point of view, and that's what we're beginning to see happen. And they have totally reinvented themselves. And I think this is the time for Perth to do that. And that's what I think Perth will do. There's quite a number of South Africans and British people that move there. There's some great innovation that comes out of Perth and that. And I think people in Perth are realizing they cannot be just recognized as a resource city, and Perth will reinvent itself. So it's still got good migration, people coming from overseas and what have you. But I do believe that economy will broaden, and that for them just to totally rely and be known as a resource centre won't be the case going forward. So we will still see great population growth, and Perth or even WA will hopefully diversify its ability to have different industries going. So, but coming back, if you were to look at, again, over the next 10 to 20 years, up to 2036, where would you invest? I would say most of these areas would be in radar. Probably the least of these would be Adelaide, because at 285,000 people, it's still okay, but as a relative percentage of what's there now, it's not as dramatic as some of those other areas. And again, probably where jobs are, the types of jobs, I would sort of look at all those other regions there are actually good areas where, again, you might see some other suburbs or regions showing, one-off year growth, but this underlying factor, both population growth and employment growth, is really what's going to give you safe, because that's our topic, investing safely. So this is our regions that we put on our radar. Then we need to drill down, but let's break each one of them down. So Brisbane, and again, we can get a bit, for us that live in Melbourne or in Sydney, we can get a bit cocky and just sort of say, well, why would you even consider Brisbane? We've just done so well. We're all geniuses here. We've made so much money in Sydney and Melbourne, and look at where Brisbane's at. But I remember, if I use the quote of a very famous investor, Warren Buffett, he says, in the short term, the share market is a voting machine, and in the long term, it's a weighing machine. All he's trying to illustrate is that fundamentally, that things will be weighed out. They will be, on their actual fundamentals will come to the right market. So you can bluff people for a little while and pretend that your company's growing and performing really well, but same thing with economies and regions and growth and that. One thing to look at is the actual fundamentals here in Brisbane, and something that we need to look at now as a correlation. Back in about 2003, 2004, what we'd seen is a massive boom in Sydney again from about 99, 2000, where Sydney had done just so well. And we're sort of at that same juncture again, where if you look at now in point 2, Brisbane is at 43% in its median value towards Sydney. For example, if there's a house in Sydney, the median house in Sydney is $1 million, it means the median in Brisbane is 430,000. That is a significant divergence. And what we're also seeing, and the numbers have already been to show that, is that since 2002, so 16 years ago, we are now at the peak again, where we're seeing the largest interstate migration coming from the southern states, where 40,000 people are coming from your Melbournes and your Sydneys or your New South Wales and Victorias up into Queensland, plus their overseas migrations. So again, those fundamentals, those people are coming, they're bringing their capital, they're selling houses, and you're thinking, well, it could be someone retiring in Sydney and thinking, I've got all this equity in my house, I don't have enough in super, so they'll sell their house here for $1 million, 1.3 million, maybe buy a place up in Brisbane or the Gold Coast or the Sunshine Coast, and have some cash parked in the super or as part of their retirement income stream. It could be young couples that think, I can't get in the market in Sydney. Yeah, I might not get as high paying job, but relatively speaking, I'm not going to have 60% more pay or less pay in Brisbane, but I'm going to get a house for 60% cheaper. So that is getting on people's radar. There's a gentleman that's moved me. When I first got married, my wife and I moved about 8 times in the first 9 years. So I contact Steve, and he's a removalist, and I've just asked him what it's like, and he could almost put him as a leading indicator. He said every week he's booked 7 days a week, and he's a hard worker, Steve, and he's just taking people up to Brisbane and to the Gold Coast, but coming back with empty trucks. So it tells you he's moving a lot of people north. The population is going to grow considerably over the next few years. Some political, and finally, the employment has been turned around when there's some state government layoffs. We're seeing Brisbane. So the fundamentals are there. And whilst it has not performed poorly, what we need to do, or poorly compared to Sydney and Melbourne, we need to see that these drivers, these factors, they're both from infrastructure, employment, population growth, all those things are driving, and people are going to look there and go, you know what? It's undervalued, just like Warren Buffett buys companies undervalued when the sentiment might not be as popular as everyone else might think, and he makes those returns. So that's something to consider and put on your radar. Macarthur, again, out Greater West, population growth, 260,000. I mean, this is just a region of Sydney, and its population growth is like a capital city, which is really significant. University, hospitals going there, the Western Sydney Airport, which is an aerotropolis that'll have billions of dollars invested in the airport, not to mention all of the infrastructure from train lines, business parks are going to be built around that. We're talking a number of things are beginning to happen in that region to make it, appealing for people. In the past, people might have thought from a socio-economic or demographic point of view as a poorer part of Sydney. In fact, it is not. I believe the Mercedes dealership out of Macarthur is the second busiest in Australia now, and also the poorest, the most lower income households in Sydney is now what we call the Middle West, areas around Lakemba and Lidcombe, where we've seen quite a different shift in demographics there. So Macarthur's a great story. So again, whilst generally Sydney might be having a little bit of a correction in that, this region where the median house prices are still a bit less than places like the Norwest areas and that, and with all this infrastructure coming through, is going to increase both incomes and population growth and subsequently push prices up. Geelong, Victoria, as I mentioned before, significant population growth. Its proximity to Melbourne, but it's been a lifestyle city, been near the water and what have you. What you're going to start seeing again is more population to go there. Affordability, it's cheaper than Melbourne, and again a number of different investments from health and research, air freight and what have you. So something to put on the radar down there as well, different to Melbourne. Newcastle. I think this is a fabulous city. It's the second largest city in New South Wales, but seventh in Australia. And a lot of people know that it's bigger than Canberra and Hobart. It's got its own airport. Its tourism is booming. There are international flights going there. It's got probably one of the largest health and university precincts in the country. A sensible infrastructure investment for their new light rail. And this one that really is fascinating is the aerospace centre. That's a $1.5 billion upgrade to the base there, but 8,500 jobs. And then it's all those different industries that service that RAF base. That'll be one of the biggest in the country, if not the biggest. And again, look at that population growth. Very, very dramatic, possibly doubling that region's current population. All right, let's look at some trends and influences globally, both locally and globally, and some things to be aware of. One thing to be that you're probably already aware of is the densification or urbanization of cities around the world. And that is that since 1997, 50% of the world's population are now living in cities, and that's continuing to accelerate. Reasons behind that is both governments and abilities to provide infrastructure and services is easier to do it within cities than trying to spread out further. The cost of that is becoming more and more costly. So what we're seeing is also, this is another interesting statistic, is most people might think of some of the biggest cities in the world, like Mumbai in India, Mexico City, Shanghai, and what have you, and think they're the fastest growing. But as a percentage, over the next 20 years, Australian cities are actually going to grow faster than them, because Mexico City is not going to go from 20 to 40 million or even that. They've sort of hit a level of densification. But what we're going to find is that Australian cities, because of our water and resource and what have you, will continue, and the policies will be around creating more density. The influencer groups, you might have heard of some of these phrases, but NIMBY is not in my backyard, where we've found people, particularly in our cities, want to protect their current space, yet they want to make housing affordable for their kids. You can't have both. The YIMBYs are more your millennials, which is yes, in my backyard, please build some more housing that's affordable in the right areas. And also the FIMBYs is the newest one I've heard of, which is public housing in my backyard. As governments struggle to provide affordable or social housing, there's going to be some new planning that comes in. One of those new planning codes that's just been ratified is the medium density code in New South Wales. We actually don't have a land availability issue, we have a planning issue. And just be aware of that. There's going to be, it's voluntary adoption by councils, but I think it'll eventually become mandatory because the NIMBYs might say, not in my backyard, but the government will say we have to house a lot of new people. You need about, you can see 2.2 million residents in New South Wales by 2036. So this new code will allow people to reuse land at a much higher densities and have different opportunities. So be aware of that. This is just some of the trends that are there. And what we'll also see is hopefully some visionary leadership from government with public housing, working with developers to create more innovative models that allow accessibility for people who can't get into housing in these cities. And it can be done. It just requires vision and leadership. What that means is you might allow a developer a higher density within a city, and that in return they give affordable or cheaper housing as a result. All right, let's move on to the next slide. So understanding some of these factors, some of this research, some of these regions to grow, what would, how do you begin to identify the areas to invest in what property markets? Doesn't mean, here's just a general rule or a general filter that we'd use. So again, I would try to identify the regions with those population growths or major cities where we've got that sustained population growth. That's what I would put on my radar. If they don't have that sustained population growth and, or employment growth, I wouldn't even consider it because I'd be looking for a medium to long-term investment. Then what I'd like to do is drill down to the specific suburbs in those areas at this particular point in time that are in a phase of growth. And it's important to use research houses to do that and find that out. Look at what's happening from local or from projects or infrastructure or master plans that are happening in those areas, because they're the things that, again, are going to stimulate growth. Then to look at the particular product. What should I have? Should I have a house? Should I have a unit? Should I have a townhouse? Should I have a dual income property or a duplex or something like that to help with my yield? They're the things that I would look at broadly to at least put on my consideration set versus, again, just saying, should I invest in one city or another city? In DPN, what we do is we actually utilize that methodology and actually spell out a little bit more. So again, what we look for is those major cities with sustainable infrastructure, population growth, diversified industries and what have you. That has to be ruled because we want to protect our downside. Again, we don't want to be in those areas that have artificial growth for a short period of time. We want ones that have consistent growth because we're going to be generally in properties for a longer period of time. Next thing is we need to find suburbs with a minimum 4% per annum growth over the medium to long term. Certainly you want to look for higher, but you just want to have that as a minimum amount because with your rental yield, you want to make sure that you're getting a return on your cost of capital. The next thing is we'll look at affordability because, again, you could find some suburbs that have great growth and what have you, and like, for example, Bondi is a world famous beach and suburb as well. But the median entry point there is over $2 million, and the affordability there is just going to stop people from being able to afford that as an investment. The rental yield will be too low. So just because it's in a major city, it's got population growth, the suburbs in it could be growing, it may not be a sensible investment from the affordability point of view. So we need to align all these. It's not a matter of just choosing one or two of these things. We try to align all 5 of these things. The fourth thing is land. As I mentioned to you before, that what we've consistently seen, and if I use Bondi as an illustration, is that houses in Bondi are worth more than units. And the reason being is because land is scarce. And what happens is over time, the buildings diminish in value. That's why they have depreciation. The buildings lose value. They get old, but the land keeps getting dearer and dearer. There's no vacant land there. And what we're finding is people ripping down old unit blocks to build new apartments and what have you. So if you can find land in major cities and good suburbs, affordability, knowing the population is going to grow, you're never going to miss out, because what will happen is that densification I mentioned to you before will occur in over 5, 10, 15, 20 years. The zonings will change and the people who are owning the land will be the happiest because more people can live on that block of land than less. And new, if you can get new properties, that helps you from a tax point of view. That's our philosophy. You pay less in stamp duty, particularly also the depreciation changes or encouragement for new property. You get the depreciation on the building components for 40 years, 2.5% of the depreciation of the building. So that again helps from a momentum point of view and a cash flow point of view, as well as the fixtures and fittings. So DPN as an organisation, I'll just quickly give a little bit of a insight on that. We've been around for a number of years, probably 22 years right now. We've won a number of awards for our approach in customer service, our strategy, and our finance structuring. The important thing is, as an organisation, is we have a research-driven approach. It's, again, when I talk to you today, there's a lot of information and general stats about regions and what have you, but just by knowing good areas to invest isn't suitable, isn't adequate enough. What you need to do is wrap a strategy around, and that really should be personalized for any investor or any family. And there's a number of layers to that as well. You need to make sure from a tax structuring point of view, work with a number of different organizations, and they look at the tax structure, which entity should be held in a family trust, through superannuation, if it's suitable, working with a financial planner, whose name should be held in from a tax point of view, depending on the income bracket, all those sorts of things. So just as well as choosing the properties, having the right structure is tantamount to making sure you get the best return as well. Make sure you might have asset protection. Those things are really important. So having the research and having the strategy are two very important things that need to be married, and you need an organisation that will help you do that, because you could have the right property but in the wrong structure or the wrong name, and it's not going to give you the best return possible in doing that. So strategy is critical in that regard. I think that's about it, David. I've sort of talked a lot.
Yeah, that's great, Sam.
If there's any questions that are coming through.
Yeah, look, we are a little tight on time, and thank you. I think we all got plenty of great insights out of that. Look, one question did come in. I thought it's probably worthwhile jumping into this one. Interest rates. We all know they've been at all-time lows. What's your view on what might happen with interest rates and investor funding?
A good question, both on interest rates and investor funding, Dave. Just even this morning, I've read that APRA, Australian Prudential Regulatory Authority, who've been tightening up lending considerably, particularly around investment, has actually loosened it up a bit. They've been successful. We've got really good regulators in trying to slow what was a boom market 18 months ago. And what we're finding is they've written to the major banks, and as long as they fulfill certain criteria, they can actually loosen up a little bit, and the banks can get some growth, because a lot of the banks did put the brakes on considering around investor lending. So what we're finding is there'll still be prudent lending going out there. There'll still be tight restrictions, but we're shifting and pivoting back towards where there'll be a little bit more liberal lending without being silly to allow investment, which is great, because we don't want to stifle the economy, and construction is probably the biggest employer at the moment, or the generator at the moment, and so it's important we balance that out and not swing to one way of constraining that economy. So interest rate rises, look, generally the consensus is that's going to be more up in the medium to long term, not in the immediate term. I think that comes more around macro economic issues around the world, where the US is moving its rates up. It's looking at dropping the corporate tax rate. There'll be a flight of capital. So at some point, we'll probably see that. And it'll be a balance with whether we have good wage growth or inflation here that will do that. But I wouldn't say it's going to be anything dramatic or immediate. But at some point, in more the medium to long term, rates will be more on an upward trajectory and downward. But I don't think we'll see massive increases like we might have had 10, 15 years ago. The economy would have to be roaring on a massive scale to really start putting the brakes from where we're at now. So I would sort of say a medium range horizon for that.
That's great, Sam. Look, thank you very much for your time today. I hope everyone really enjoyed that session. Look, we will be sending out a quick survey, so please tell us what you think. We'd love to hear what you want to learn about from DPN. We hope you got some value out of this. Please share this content. And look, if you've got any queries, you can always contact us at DPN. You can visit our website, dpn.com.au, or alternatively, you can even drop Sam an email. So that's just sam@dpn.com.au. Till next time, wishing you all the best. Enjoy the rest of this lovely autumn weather, and we'll see you on the next webinar. Thanks very much.
Thanks, David. Thank you, everyone. Cheers.